You don't need a finance degree to pick good stocks. Here's our 4 steps to analyze any company. Welcome to Get Started Investing, a show that helps you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. It can feel like now might not be an exciting time to be in markets.
Yeah.
But for people like us who have been in the market for a long time, as I say that, I realize that that's making us sound old, and we actually haven't been in the markets that long. But we've been in there long enough to know that when share prices fall, you can be panicked,
Yeah.
or you can start to think stocks are on sale.
Yeah.
And that's an exciting time to be in markets because we know that over the long term it trends up, and we know that buying when markets are falling has been a good thing in the past. The question is, how do you find the right stocks? How do you find those great stocks? And today we're going to show you how.
Yes, today's episode has been prompted by a question that has come in from Bailey.
G'day guys, Bailey here. I just wanted to ask a bit of a question when investing in individual stocks. So currently I just invest in ETFs, looking at a few individual stocks that have been interesting me, but just unsure where to start, even looking into the company and different areas of the company. And I suppose to tell if it's a good company to invest in or not. But your thoughts would be appreciated.
Love it. Thank you so much for the question, Bailey. A reminder that if you would like to ask us a question, you can do so by leaving us a voicemail. There'll be a link in the description or in the show notes below. Before we jump into unpacking our 4-step process, a huge thank you goes to our new long-term partner here at Get Started Investing, BetaShares Direct, Ren.
That's right, Bryce. Let's talk about brokerage.
Love it. Let's do it.
If we're going to be buying individual stocks, it's something we've got to think about.
Absolutely.
Here's a question for you.
Yeah.
Have you thought about how much you're paying on brokerage every year?
Not something I think about often. I do a review quarterly though, and it's more than I would like.
Well, it's good you know it's too much. It's time for you to do something about it, Bryce. We all know that minimizing costs helps to maximize your investment returns, and that's why we're happy to have our new long-term partner for this show, BetaShares Direct, where you can invest brokerage free.
Love that.
In all ETFs, not just BetaShares ETFs.
Also love that.
As well as over 300 shares traded on the ASX.
Also love that.
Love that. And the best part is that zero brokerage is BetaShares Direct long-term commitment to investors. So go to betashares.com.au/direct to learn more and to sign up.
BetaShares Capital Limited is the issuer of BetaShares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you. Investing involves risk. Refer to the PDS for info on other fees and costs.
All right, so Bryce, let's get to this question. What makes a great stock? How do we analyze stocks? And really, in this episode, we're going to start by talking about what game you're playing.
Yeah.
And then we're going to go through our 4-step checklist, talk about how we can work through each of those steps in a bit more detail. And we're going to close with an example, a worked example. But we've got to start by asking a question that I think not enough people ask. What game are you playing?
AFL. Love it. Not my best.
Not your best.
No, you're
Certainly
right,
not
you're
in
right.
the comedy game. I'll put it that way.
Comment below if you thought that was a good segue. Anyway, look, you're right, Ren. There are plenty of ways to make money in the stock market, and it's important that you understand the way that you're trying to make money in the stock market. You would have heard things like value investing. You would have heard momentum, looking for quality, looking for growth, technical analysis, day trading, you name it. There are plenty of ways to make money in the stock market. And all of them work at different times, and all of them, and people make money in many different ways. But when it comes to understanding what works, they all have different methodologies of going about it.
Yeah, and I think to this question that we're answering today, what makes a great stock, they all have different answers to that question. Let's look at a momentum investor, which is like a pretty far step removed from what we do. What makes a great stock for them will be a lot of, I guess, momentum indicators or technical indicators. Where's the relative strength indicator? What's the 30-day moving average versus the 90-day moving average? Like their indicators and their criteria are just completely different to what we're going to talk about today. But it's not like they're wrong and we're right, or vice versa, because we'll make money, they'll make money. Whichever game you choose to play, if you play that game well and consistently and in a disciplined way, you can make money in the share market. So I think it's not about, there's not one right answer to this question, but it is having a clear and consistent answer to this question.
Yes.
The follow-up question becomes, what game are we playing?
We are playing a game of trying to find long-term compounders that are great companies. We are looking for companies that become great investments.
Yes.
That is the game that we are playing.
Yeah. So Bryce, looking for great companies,
Yes.
because great companies become great stocks and great investments over the long term. That leads to our 4-step checklist. So let's hit them briefly and then we'll go into detail.
Alrighty.
So point number 1, a company that makes a great product or service. Number 2, they can earn above market profits from that product or service for years to come. Number 3, they can reinvest that profit in productive ways. And then finally, we can buy that company at a reasonable price.
Simple. Who needs a finance degree when you have a simple 4-step checklist like that? So let's take this step by step, starting with number 1, and that is to find a company that makes a great product or service. The question is, why is that where we start? Fundamentally, as a business, you want to be answering, or you want to be serving your customer.
Yeah, I mean,
if you're not making a great product or service that is what your customer wants, you're not going to be a good business.
That is why companies exist, really. Like that is capitalism at its core. And if a company isn't satisfying its customers' wants and needs, then
Shit company.
everything else doesn't
matter.
It doesn't matter what valuation it's trading at.
Yeah.
It doesn't matter
Management.
how good the management is.
Yeah.
Like if it's fundamentally not doing something that people are willing to pay for, don't invest in it.
Yeah. And you hear that carried through time and time again with great companies. Bezos' obsession with the customer.
Yeah.
There are just plenty of examples of why this is a good place to start. So that's the why, but the question is, how do we find companies that create good products and services? And there are different ways you can do it. Firstly, product reviews. Like, do customers outwardly express their love of the product?
Yeah, and for me, customer reviews is like formal and informal. So formal is you could be looking at Yelp, Google reviews. You could be looking at Glassdoor's more about the company culture, but like there's a bunch of websites where you can look at reviews. Amazon, go and look at their Amazon page and see what the customer reviews are. But it's also informal reviews. It's like, what are your mates talking about? Like, what's the new thing they bought that they're obsessed with or that people are saving up to buy? Like, what are your kids talking about?
Yeah.
What's the school talking about? What are you seeing like getting more and more shelf space at the local shops? Like, all of that feeds into like, what's hot?
Yeah.
What
What's
do people?
hot? Yeah.
What do people want to spend
Finger
their
the
money
pulse.
on?
Yeah, exactly. Some other ways, so market comparison. So this is, I guess, how it's perceived and sits against other products in the market. If it's sitting at the top, then customers are obviously choosing it over substitutable products.
And then finally, there's some financial metrics. You can look at, is revenue growing? Is profit growing? And what's its profit margin and how consistent that is. So I think that's some things that can point to, is it satisfying customer wants and needs?
Yeah.
Which leads to point number 2.
Point number 2, can they earn above market profits from the product or service for years to come, year after year after year?
Because the nature of capitalism is someone will have a good idea and then people will copy it. And that first person could have made a lot of money early, but over time, those profit margins get competed away as more and more people see that customers want this and try and do it cheaper or more efficiently or in different ways. That is the story of capitalism. The story of investing is finding those few companies that don't get their profits competed away over time, that continue to make high profits for years and decades to come because they're the best investments. They're the Apples, or in a generation before, they're the Walmarts, those companies that just keep doing the damn thing. So to ask, can a company keep its high profit margins for years to come? We introduce this concept of moats.
Yes. So a moat is a way, or is a characteristic that allows a company to sustain its competitive advantage. There's a framework that we like to use called Helmer's 7 Powers that goes through 7 different ways that companies can, I guess, maintain or develop a moat. But the fundamental thing is that at the end of the day, these moats allow or ensure that their customers don't go to competitors.
Yeah.
If you want more information, we did do a deep dive on moats in our ETF Explained episode on the Morningstar Wide Moat ETF. So we'll include a link in the show notes.
Yeah. So the company is satisfying a customer want or need, and it can continue to earn a good profit on doing that for years to come. That's great, but that doesn't make it a long-term compounder yet. Because a company that makes a lot of profit but then just doesn't do anything with that profit, or in the case of a lot of companies that we can think of, wastes that profit, invests it poorly perhaps with some ill-timed acquisitions or maybe some ill-fated adventures overseas, that's not great.
No.
So that leads to the third part of our criteria. The company can reinvest that profit in productive ways.
Yes.
And the examples of companies that do this well are companies that have a long growth runway doing the thing they're doing well. So it might have been Apple making computers and then making phones, and they're having a massive growth trajectory in terms of just doing the same thing, making more of the same product and selling more of the same product globally. Or it could be a company like Berkshire Hathaway that takes that profit and then reinvests it really effectively in other businesses or in stocks, because Warren Buffett is the greatest investor of all time. So there's not like one way that the company needs to reinvest. What you just want is a company that will reinvest it sensibly and profitably. And there are a couple of metrics that we can look at to see, is the company doing that? Now, at this point, it does get a little bit technical, but there are two metrics that we would look at: return on equity and return on invested capital. And what both of these are trying to do is look at the money that the company has, how much profit is it making with that money. And the higher the return, the better the company is using the money it has. Return on equity looks at the equity, like the money that shareholders have put into the company. Return on invested capital looks at both equity and debt, but looks at capital it's investing in new things each time. But really what you're trying to do is this company taking the money it's earning and investing it in a productive way.
So, Ren, we've found a company that their customers love. We've found a company where they've been able to generate above market profits time and time again and reinvesting them back in productive ways. The fourth and final step is to be able to then buy them at a reasonable price, because if you're paying too much for a company, despite that company ticking all of the criteria above, the price you buy it for really dictates how much money you're going to make. We're going to have a look at some of the key ratios or key ways to determine the valuation of a company. But just a caveat that there's going to be a bit of jargon here, but don't be put off by it, because A, at the end of the day, if you want to invest in individual stocks, you're going to need to understand this. But B, focus on the first three steps before you, get overwhelmed with some of the ratios that we're talking about. The good news is that they're all available online, and there are calculators to help you. We've developed a checklist that you can download to accompany this episode that you can use to work through each of the steps with a worked example as well. But Ren, do you want to take us through each of the 4 ways in which you can find whether or not a company is reasonably priced?
Yeah, so I think there's probably 3 buckets. I'm going to group the third and fourth into one bucket. So the simplest way to value a company is to look at price to earnings ratio, which is share price divided by profit per share. And it's like a shorthand way of saying how much are you paying for each dollar of profit, essentially. And the lower the price to earnings ratio, the better. Different industries have different price to earnings. You know, like a tech price to earnings will be higher than a coal miner.
Yep.
So have a look at how the company you're looking at compares to other companies in the same industry. How does Apple compare to Microsoft and Nvidia? And you can get a sense of, is it cheap on a relative basis? So that's the simplest and quickest valuation. If you want to go one step further, you can look at price earnings growth ratio, or PEG, where you take the price to earnings and then you divide it by the forecast growth, earnings per share growth rate, how fast it's going to grow its profit, essentially. Because a company that's growing faster, you should be willing to pay more for than a company that is growing slower or isn't growing. So that's what the G and the PEG takes into account. As a rule of thumb, this is super rough. I'm not sure it's perfect, but as a rule of thumb, 1 PEG is kind of fairly valued. Above 1, you're getting into overvalued. Below 1, you're getting into undervalued. So that's the second level. The third level is the discounted cash flow. And here what you're trying to do is forecast how much profit a company will make into the future and then discount it back to a value today. Because $1 that you've got today is worth more than $1 you'll get in the future. We won't get into the technicals of why, just trust us on that. So that's what a DCF is what you'll hear. I think an easier way to approach DCFs is a reverse DCF, where you just look at the company's current profitability and the current share price, and you essentially are asking what growth rate does the company need to achieve? How fast does it need to grow to justify the current share price? And you can look at what the market is expecting in growth via this reverse DCF, and you can compare it to what you think is reasonable or what the company's done historically. So that can be a little bit of a shortcut. But look, yeah, as you said, this is where it gets technical. This is where the rubber hits the road. But in some ways, this is where the money is made.
Yeah,
so
absolutely.
You've got to do the work, unfortunately.
And it will come, trust us. We had no idea about these when we started, and you can tell by Ren's explanation that you can absolutely get your head around it. We're going to put the 4 steps into practice using Alphabet as an example, the parent company of Google, starting with the first step, which is to find a company that makes a great product or service. And Ren, I think it goes without saying, we know that this sort of ticks the box for Google with 95% market share in search globally. Everyone knows Google. In fact, it's just become it's become a word, Google it. So we're safe to say that customers love it. But if we look at revenue and profit margin as well, the story also plays out.
Yeah, that's right. So the last 3 years, revenue has grown at 11% per year on average. So it's still growing in double-digit percentages. And its profit margin is very healthy, 29%.
Step number 2 is, can they earn an above market profit and do so consecutively year after year or consistently? So their profit margin has been increasing year on year for the past 5 years, 22%, 30%, 21, 24, 29. So they are consistently profitable and they're consistently growing their profit margin. And they do have a moat, Ren.
Yeah. Now, we didn't explain all the different types of moats, but I think you finished it with the question, does the company have something that will stop their customers going to a cheaper competitor? And I think intuitively with Google, we know that is the case.
Yes.
We know that advertisers aren't going to a competitor. We know that users aren't going to a competitor. We know that, it's just so powerful. Like, we're just burning time if we explain how powerful Google is. So let's move to question 3.
Can Google reinvest the profits that they make in productive ways that return value to the company? And that is looking at return on equity over the past 5 years. Their return on equity as a percentage over the past 5 years is 19%, 32, 24, 27, and 33%. Hard to contextualize that, Ren, but what is a good baseline number?
So you'd sort of say like the overall average across history and across companies is around 9%.
Yeah.
And that sort of gels with why the long-term average of the stock market returns is about 9% as well.
Yeah.
Anything above 15%, you start to get really excited. Anything in this Google range of plus 25%, you start to pull your wallet out.
Yeah, absolutely.
As long as you answer question 4 in the right way, you don't pull your wallet out otherwise.
That's right. We've got our wallet halfway out of the pocket. Can it be bought at a reasonable price?
So as we said earlier, there's sort of 3 tiers to this analysis. The first tier is you look at price to earnings. Google's price to earning is 19. But you don't look at it in isolation. You compare it to its peers, and compared to all of its big tech peers, it's cheap.
Yeah.
Well, it's cheaper than all of its big tech peers.
Yeah.
So that's one way to think about it. You can look at price earnings growth, which is where you look at the price to earnings and then divide it by the expected growth rate. It's actually expensive on this metric. It's 1.5. And as I said earlier, the loose rule of thumb is anything above 1 is expensive. The reason I don't love that rule of thumb is because basically everything these days is above 1.
Yeah.
So I think there might need to be a bit of a recalibration. But anyway, separate conversation.
Yes.
The third level of analysis is a discounted cash flow, or as I was explaining earlier, a reverse discounted cash flow. So using today's share price of about $159 and using a discount rate of 10%, basically what the market is expecting is it grows earnings per share or grows profit at about 12% a year over the next 10 years. So the question is that realistic?
Yes.
Well, over the past 10 years, it's grown earnings per share at 24% a year.
Yeah.
So the market is expecting Google's growth to slow down. Not surprising. It's
Yeah.
already $1 trillion company. And so the question you have to ask if you're thinking about, is this valuable or is it overvalued, is does 12% a year for the next 10 years seem realistic?
Yeah.
And those are the questions that keep investors up at night. And those are the questions that if you can answer correctly,
That's what makes you the money.
That's what makes you the money. Yeah.
That's it. Well, those are the 4 steps through the lens of looking at Google. Just to recap what those 4 steps are: finding a company that makes a great product or service that can earn above market profits from that product or service for years to come, that can reinvest that profit in productive ways, and that can be bought at a reasonable price. 4 steps to help you analyze any company, no matter where you are on your investing journey. And a reminder that if you want to walk through this checklist yourself, it is a downloadable resource. We have a link in the show notes. We point you in the direction of the where and how to find all the information on the company and how to apply it to the 4 steps that we just walked through.
So Bailey, a massive thank you for your question. I think, if you're keen to move from ETFs to single stocks, hopefully this episode has helped you. I think it's a very exciting part of the investing journey. So keep going. As Bryce said, download the cheat sheet. Hopefully that helps you as well. And if you find what we do helpful or interesting or sometimes funny, probably not from Bryce,
My
given
AFL
his
joke was pretty good.
AFL joke, please do subscribe wherever you're watching or listening. It definitely is a good way for us to juice the algorithm and get in front of more people. It also means you won't miss an episode. So it's really a win-win for both of us. But Bryce, that'll do us for today. We'll be back in your ears or on your screens next episode.
Sounds good.